Okay, I think we'll in the interest of time we'll kick off. So welcome everybody to another Toast webinar. This one's scheduled for about 30 minutes, so we're going to try and wrap through as much content as we possibly can in that period of time. We're very aware that you have other things to be doing. The topic for today's webinar is tax savings for directors. So it's probably one of the most frequently asked questions or challenges that any business owner has, and it really comes at a point where the business is doing well, you've gotten it off the ground, and then really what comes next is how do you make the business kind of work for you as much as possible. And at Toast, that's pretty much what we focus towards. Is we want to make sure that it's run as tax efficiently as possible, both on the company side and then for you as directors. So speaking today, we're joined by Stephen Kivelhan, who's one of our senior accountants here at Toast, and I'm a partner with Toast as well. So we pretty much control all the operations within the firm, and we would be your points of contact for any of the advice side information. So when you're setting up a limited company, it can be exciting because it's your first venture, and as I said, we're probably here talking more towards a growth phase company where you've gotten it off the ground operationally, things are going well, the cash is starting to come in, and as I said, the next phase for any director is to see how do I pay myself and how do I pay myself as efficiently as possible. So really, that's the most common, I think, question that we would get asked. So what we'll cover today are the main tax efficient methods of extracting cash from the business. So as you see on the screen, it's salary versus dividends. Again, very, very common question from a director, which is better? And actually the answer is a combination of the two, but it does really depend on your individual circumstances. So this is where having somebody proactively looking at the financial position of the company and at your financial position and the financial position of your family can impact what decisions are there, because it does kind of dictate, or it is dictated by what other sources of income you have currently, and how much cash there is within the business and what the kind of growth strategy of the business is. So it's an important decision, and it's one that you probably need to take kind of professional advice on, or people who are used to doing it. The second one we'll touch on is pension schemes. Changed recently in the budget, and they've actually relaxed the terms or made them more beneficial. So we'll cover that. Third is benefits in kind. So these are probably less common than the first two, but still very, very useful. And then fourth one, directors' loan accounts, we'll touch on, and then reimbursement of expenses. So we'll try and wrap through. As you'll see, that's quite a lot to get through. So without further ado, I'll pass over to Stephen and he can get us started.
Thanks, Michael. Yeah, so the first one that Michael touched on really was with regards to the salary and dividends. Now, as a limited company director, you do have a lot of flexibility as to how and when you pay yourself. Now, it's one of the benefits that you do have of being a director, but the salary and dividends is probably the most tax efficient and one we see most often, and one that we would be kind of advising our clients have recently set up new companies of going down this route. Now, it really is dependent on if there are any other sources of income. If there's no other sources of income, then yes, this is the route we would advise you to go down, taking a tax efficient salary and drawing the rest down as dividends. If there's other sources of income, then it's a different conversation to have, because your other sources of income could be already eating up the allowances that you have available to you elsewhere. So therefore, that it's kind of one of the first talking points we would have when it comes to extracting cash. Okay, do you have other sources? No. Okay, this is the starting point, basically. So there's differences between both. Some people think they have a limited company, all the money's theirs, and that's kind of, they can just extract it as and when they need it, basically. But that's not the case. The best way to do it is taking it in a form of a salary, and then the remainder as dividends. The reason why is that taking it as a form of salary, yes, you may be subject to income tax and national insurance contributions depending on the amount you receive. However, there's a way that you can structure it, and we'll touch on a couple of the most tax efficient methods on the next couple of slides. There's a way that you can structure it in a way that you won't incur any taxes on it, but you can still extract it because you have that tax-free allowance that you can draw down on. So in terms of the differences between the both, salary, you can see, yeah, maybe subject to income tax. One of the downsides, I suppose, is that it brings some additional admin requirements in that you'll be required to operate a payroll in order to run that salary through it. So you kind of take a payroll, you put through your most tax efficient salary, you submit those submissions to HMRC every month or every week, depending on how often you pay yourself. So it's one downside to it. One benefit of it is that as a company, any expenses that can reduce your corporation tax is good. If you can reduce your corporation tax as much as possible, then it's a benefit to the business. The salary aspect is tax deductible in the accounts. So any salary you pay yourself, you can deduct that from your overall profit, reducing your corporation tax. Employers' national insurance contributions may arise, depending again on the level of salary that you take. However, there's a kind of a £5,000 employment allowance that you can declare against that, so we would reduce it as well. And again, given the flexibility of it, as a director, you can take the salary as often as you need it. So you can decide if you want to do it weekly, monthly, annually, or at any other intervals that you decide. So that's one of the other benefits that you have. But the last thing then to be mindful of is whatever salary you do draw from the business, you will have to pay or have to declare that on a self-assessment. However, like I said, there will be no income tax suffered depending on the amount of that you take. In comparison with the dividend side, so dividends is much more tax efficient than it is in a salary. So that's the reason why you want to take a small salary and then take the rest in dividends. You can see there that there has been recent changes to these in terms of the rates. They have gone up by a percentage across the board, but they're still more tax efficient. So if you look at it from a salary perspective, the basic rate in terms of a salary is at 20% currently. However, if you take a basic rate up to the dividend in terms of dividends, you're only taxed at 8.75%. So you can see there's a much more tax efficient method of extracting it if you take it via dividends. It is a big jump then to 33.75% and 39% in terms of the tax as you go up in bands. However, it's still much lower than if you were to take it via a salary. So that's the reason why you'd want to split between both salary and dividends. Now, the next one, and it's one of the most recent changes with the budget, is that the £1,000 dividend allowance has reduced. It used to be 2,000 that every director was entitled to tax-free, so they could draw that out tax-free, not incur any additional tax on it. That's now been reduced to 1,000. Oh yeah, it's still good and that you still have that available to you, but it will reduce further then in the 24-25 tax year to 500. So they're slightly becoming more stricter and kind of less tax efficient. However, overall, it's still a better overall package to take it in the form of a dividends. One important thing is that the company must have sufficient funds in to be able to declare dividend and pay that out. And what I mean by that is that, you know, if you can't really take the money out if the business doesn't have enough to kind of run day to day. Basically, it needs to have sufficient reserves there in order to make that dividend payment. And in comparison to the salary, it's not tax deductible in terms of if you take a salary, it reduces your corporation tax, whereas a dividend doesn't. You can't reduce your corporation tax profits with that. And then a few other ones is that the dividend can be paid regularly, and again, that can be decided internally. So if you want to take them quarterly, annually, or on more often, there might be a few additional kind of requirements you need to go through in terms of board holding minutes and declaring those dividends in the required documentation. But like, we can keep you right, and your accountant can keep you right in regards to that. And lastly, any dividends alongside your salary will have to be declared on a personal tax return. But overall, it's the best package to be on because you're going to be saving the most tax through that way. And we'll touch on a couple of the most tax efficient ones.
Yeah, sorry, I should have said before we started, if there's any questions at any stage throughout, we'll try and work through as many as possible. So feel free to ask those. And secondly, we'll be sending out a copy of the slides. So, you know, don't kind of worry that you have to take notes or anything during the conversation or during the webinar. So we will be sending a copy out, and there will be a recording of it as well. So next one.
Yeah, look, one question we always get asked is, so what is the most tax efficient salary? And it has changed recently because of the budget and the increases in the bands, and they've been coming, you know, they change quite often. But the most recent one, and this is kind of really dependent on how many directors there are, does the company have employees, within the company also. And the reason why that's important, it boils down to the employment allowance that's available to you. So if you're a company and you're the only director, you have no employees there, you're not eligible for that employment allowance of £5,000 a year, right? So if you're in that position, you have no employees, then the most tax efficient salary for you for the current tax year, which we're currently in, would be 9,100 per annum, which 758.33 a month. That's the reason being is that, you know, it's at the secondary threshold, so your company won't pay any employer's national insurance on it, but you're also over the lower earnings limit, so you'll still earn your national insurance credits. So it's things like further down the line that it'll entitle you to things like state pensions and things like that. So it's good in that way. Another benefit of it is it's less than the tax-free personal allowance. So everyone's personal allowance may be different, but the current one is 12,570 per year that everyone's entitled to. So as long as you're below that in terms of the salary, then you won't incur any income tax. But lastly, what I've said is that the employment allowance, if you're a sole director and there's no other employees, you're not actually eligible to claim that employment allowance. So that's the reason why the salary is a bit lower than what the one we'll discuss next, which is, you can go on to the next slide, and I might go. So where the employment allowance can be claimed. So if you're a business with 2 or more directors, for example, or if you have a few employees, then you will be eligible for that £5,000 employment allowance. And basically that makes a difference then, because you can take a drawdown a salary of 12,570. All right. It will incur some employer's national insurance, but you're always going to get that credit to negate those national insurance contributions there. So that's the reason why 12,570 would be still beneficial. It's still under the personal allowance, so there's no income tax. You're still over all the thresholds that entitles you to state pensions and that down the line. But the most important thing is that to be eligible and to get this form of salary, there'll have to be other directors and employees involved.
Yeah. And as you can see, that's kind of where we would suggest that advice really dependent on the company circumstances and your own personal circumstances is so vital, because whilst there are good savings that can be achieved here, it is actually putting together all of the information in relation to the company and the person to actually determine what the optimum situation is. And it really is why getting professional advice in relation to it is a good idea, and it does save you money over time. Next.
Okay, so one of the most common issues and problems that you come across with companies is that, particularly new companies that start off and they don't understand the idea that limited company is a completely separate entity and it's separate to you. Although you're the director and shareholder, you're not. They're both completely separate. They come across a lot of times where people basically treat it as a personal bank account because it's their business and they kind of take funds in and out of it. So this is where directors' loan accounts kind of become important and become part of the conversation with limited companies. So you have 2 potentially different scenarios with directors' loan accounts. There'll be a time when directors' loan accounts that the company owes money to you. Now that might arise where you started the company, and to get it off its feet, you've injected some cash to get it started with. So you've had some savings set aside and you've put this money into the business to get it up and running. Usually that's the first thing. If we're looking at it in order to extract cash, we'll look at it the first thing and go, okay, have you introduced any funds to it? Yeah, if you have, then okay, you can now start to take those funds out if the funds permit, and you'll not incur any taxes or anything with it. They'll come out straight away. And it's the first thing that we'll look at, and you'll see it's 0% rate of tax. So that's the position that you want to be in, basically, when it comes to directors' loan accounts. And the flip side of that, and we'll touch on the next slide, is it becomes more complicated and there's taxes involved in when that director's loan account is actually overdrawn. So that's what we'll touch on the next ones.
Next one, ready?
Yeah. So the flip of that, you owe money to the company. So how would this arise? So if you're using the business bank account and you're using it personally, so you're using it to fund personal expenses that aren't actually business related, what happens is that basically is money that you owe the company back then. So you're basically spending the business money for your own personal use. you will owe that the money back to the company. So the director's loan account is kind of like a virtual bank account in a way. You know, it's kind of treated money in, money out, depending on how often you use it. If you're using it for personal use, and at the end of the year, there's a big sum in there that you've paid, you've used it personally, okay, then there's potential tax implications involved with that if it is still overdrawn. Now, that tax is known as the Section 455 tax, right? And what that is that if your director's loan account is overdrawn at the end of the year, so if it's overdrawn by whatever amount, if you do not repay that amount back to the company within 9 months of the year end, then there's a Section 455 tax that's applied to that amount that is overdrawn. Now, you can negate that and kind of avoid paying this tax, but you would have to repay the company back the amount that it was overdrawn at the year end within that 9 month period. So if you do that, there's no taxes to worry about. However, you still have to document that on the corporation tax returns and things like that. So you still have to let HMRC know that, yeah, although it was overdrawn, we still repaid it, and we repaid it on this date. Therefore, you don't owe any tax, but it just keeps everything above board. But there's other situations where, and it becomes in line with the dividend. So if you're using it personally throughout the year, which is what we see sometimes, and then at the end of the year, the business does have sufficient reserves that they can declare the dividend. One way of getting rid of this overdrawn director's loan account is that, okay, you've used it personally throughout the year, there's about £10,000 there overdrawn. However, the business does have reserves in order to get rid of that. Then we'll declare the £10,000 as a dividend, essentially. And what that'll do is it wipes the director's loan account to zero. And then that 10,000 is then declared on your own personal self-assessment, but taxed, like we touched on before, at the most tax efficient rates. So it could be 8%, 33%, depending on how much your overall earnings are. But yeah, last few ones then in terms of if you're not able to repay the loan. So like I said, if you're not able to repay it, so if it is overdrawn, but you're not in a position to repay it back within the 9 months, then the company can elect to write it off. However, if the company does that, it's still treated as personal income to the director and still treated the same way. It has to go on a self-assessment and pay tax that way. And the last one, how do you deal with an overdrawn one? Like I've just said, you can declare dividends, but just be mindful that there will be tax implications, albeit at a much lower rate.
Just a question before we go on to the next slide. Even if you have no employment allowance, can you still not pay 12,570 as corporation tax savings will outweigh the employer's NIC?
Yeah, you can. So that's the 12,570 is probably the one we use most often, right? It is just because of that additional kind of making payments over to HMRC or whatever, and then declaring your credit against that. You can still do it, and it's still it'll still be the same outcome, and that you won't pay any taxes or anything involved with it. But it's just that comes with additional bit more requirements and obligations in terms of the employer's allowance and submitting a claim for it and stuff like that. But overall, yeah, you can still take the 12,570.
Okay, and just another one. So what's the tax payable under Section 455 for director's loan?
There's a certain percentage calculated. It's calculated 33.75%, I think, currently, of the overdrawn amount at the year end. So that tax is automatically put on there once if it's still overdrawn at 9 months after the period. So it's pretty hefty, and it can be depending on how much the amount is overdrawn by. But I mean, the flip side of it, if you do repay it in future, then you can potentially reclaim that back as well. So we can always potentially revert to get it back, but it's just something you really want to avoid in terms of having an overdrawn director's loan account for that length of time.
Yeah, because remember this is 9 months after the year end, so
yeah,
so there's probably a substantial amount of time has passed. So it isn't a position you really want to get into, particularly year on year, because like Stephen said, it can be particularly heavy. I'm just conscious of time. In relation to pension contributions, these are one of the most tax efficient ways of extracting capital kind of after the salary and dividends. So in the most recent budget, they relaxed the rules, and maybe it's with a view to the future pension requirements. So they increased the amount that the company is allowed to pay on your behalf from 40,000 to 60,000, and they've also changed some of the rules in relation to lifetime allowances. So that's actually been removed. So there were caps in relation to how much you were allowed to pay, But essentially, that means that you can now pay £60,000 if the funds are there within the company, and essentially get a corporation tax saving of between 19 and 25%, dependent on what your profit rate is for the company. So it can mean that for every £100, like it says in the slide, for every £100, it'll cost somewhere between 75 and 81. So you're getting the additional benefit into your pension, of 25%, which is great in a tax. No, there's not very many that are that efficient. So it is one that we would look at, and again, it is something that it has to be paid before the year end. So this is where kind of the real time advice comes in, is that if you can make an estimation of what your corporation tax liability is likely to be, it can provide a tax planning opportunity in the sense that you can then say, okay, I know there's sufficient cash in the business. I know we're going to have a heavy corporation tax exposure. If I make a pension contribution, at least I'm going to get the 25% relief on that. So it can minimize the corporation tax liability of the company, and you get then the funds into your personal. Albeit some directors don't like the fact that it's going into a pension and they can't touch it. But unfortunately, those are the rules. So benefits in kind. So do you want to go for benefits in kind, Stephen, or do you want me to do it?
Well, look, it's fine. I can go through it. So yeah, in addition to wages and salaries, there's many like things that you'll come across in which employees and directors and that have in addition to their salaries. So those things tend to be the likes of a car, so like a company car, if there's like health insurance or childcare or anything, that the employer will pay on behalf of the employee. And these are referred to as benefits in kind, or simply as benefits. So there is a tax charge. The charge to tax on employment income specifically includes any gratuity or other profit, incidental benefit of any kind obtained by the employee. So that's just the definition of it. Really, boring and kind of.
Just on that, there's ones that are becoming kind of particularly relevant. A lot of directors are choosing to take private medical insurance because of the issues with kind of the NHS, and it can be a very tax efficient way of doing it. So particularly directors that are maybe paying private medical insurance personally, it can be something that the company can provide on behalf of the directors, but obviously there are tax implications for the company doing that. But it can be a good way of extracting cash. Secondly, another one is kind of electric vehicles. There are a lot of directors are opting for pretty nice cars, because the tax savings on them is maybe making it a bit more financially viable to do that. So it is something that that the government are trying to encourage, is the transition to electric vehicles. So it can be a good way of doing that, but there are benefit and kind tax issues around those particular things.
There is, and then there's things like what's called a P11D that all directors would then have to submit after the year end. It basically outlines on that what was the benefit that you received for that period. So if it was a vehicle, what were the details of the vehicle, and then you'll have potentially an additional tax liability on top of that. So it all can be very dependent on which benefit you've actually in receipt of. Cars and vans are a bit different in that they kind of works off CO2 emissions, and if it's an electric vehicle and stuff, it can be a bit more tax efficient and a bit lower in terms of the overall tax exposure. So every one of them are different, but there's just some additional things to think about from a tax perspective.
Good. Okay, so reimbursement of expenses. I think we have 5 minutes. So any other questions or anything, we can go run through them.
Yeah. So it's pretty self-explanatory. So it's one of those things where if you have a company, however, you've paid for things in a more personal capacity. So if you're out and about and you have your own personal card or whatever with you, then you can pay for those. However, you are then entitled to have those paid back to you by the company, and this can be in a number of ways. So if it's like staff parties, or if it's kind of paying for a meal or other things like that, that you can be reimbursed for by the company. But you have to make sure, and HMRC would have to be satisfied that that expense that you're actually being reimbursed for is wholly and exclusively for the purposes of the trade. You can't be something that's kind of, if it's 80% and 20%, it kind of has to be wholly and exclusively. There can't be any middle ground on it. It has to be for the purposes of the business and the business alone in order for you to be reimbursed for that. But annual parties and stuff like that is something you'll come across most often, because they can happen maybe once or twice a year, kind of thing. So that's things like that you will be able to be reimbursed for.
Yeah. And it is, I mean, what we tend to find is that some directors can lose track of what expenses they're incurring as they go, and ultimately that means that they're losing any tax allowance associated with it, so they're having to pay tax on it. So that's really not a position that is good as a director. So we try and make it as easy as possible for people, that they can keep track of their receipts whilst they're on the go. So like use of certain apps to capture the information and make sure that they are actually claiming the rightful expenses that the company is incurring, or they're paying on behalf of the company. And that all adds up over the course of the year. So it all goes down towards your net profit figure, or reducing your net profit figure, and ultimately what your corporation tax figure is calculated from. So as long as that method is quite good and practical, it does make it easier then for directors to reclaim what is rightly there. Now, there are certain ones that there can be a proportion of it allocated against the company. So if it's not used fully, there are certain things that can be looked at and applied. But like Stephen said, it does have to be wholly and exclusively related to the trade. So you need to be careful about what you're doing there. I'm kind of conscious of time that we need to wrap up, and if there's any other questions that we have, please feel free to put them in. But just about Toast, so among the services that we provide, we do, and as it says, income tax registration, annual accounts, payroll, software subscription, and self-assessment. But essentially what we want to do is use technology to kind of keep track of all the income and expenditures, and that then allows us to give the best advice possible to the company and then the directors and shareholders associated with that company. And really that's using it in real time gives us a view of the future, what it's going to look like, and then we can proactively tax plan and give the business kind of advice in relation to how it actually operates, and create some efficiencies as it goes. So that's essentially a short bit about Toast. So the final thing for me is thank you very much for attending the webinar. If you have any questions, feel free to send them through. There's contact details here. You can follow us on any of the social media platforms. We seem to have all of them, I think, at this stage. And if there's ever, if you want a free consultation with us, you can book that through the website. And again, it's completely free of charge, and we'll just run through kind of what pain points that you're having with your current setup, and we can give you some general advice there. But thank you very much for attending, and have a good rest of the day.
Thanks, everyone.
Thank you.